Morning, folks, and welcome to our Wednesday morning training session with GoPro Trading Academy, and presented by yours truly, Ian Giffen, on this beautiful Wednesday morning, coming to you from the Southern Cape of South Africa on the Garden Route, where the sun is shining. It's a bit cold outside, but it really is a beautiful day. Right, so today's topic is overtrading and correlation. They may not seem connected, but they are. So we're going to be talking about correlation with the focus really of explaining why overtrading can also be very bad for you in that context. But obviously that is also a bigger topic. It's going to be a bit more of a subjective discussion today. So please feel free, as always, to ask your questions, drop them into the chat box. Alternatively, if you're watching this as a recording, you're welcome to put it into the comments below, and I'll get back to you with a considered answer. Right, so let's start off with just a general chat about correlation, what it is. Does it cause a problem? Is it good, bad? What is the issue? So correlation is quite a broad term, and it can be identified in different aspects of trading. The obvious one I think that most people are aware of is correlation across instruments. And we talk about a positive and a negative correlation. If something is positively correlated, it means that it tends to move in the same direction at the same time. If it's negatively correlated, it tends to move in the opposite direction. Some instruments like Euro USD compared to USD Swiss franc would have a negative correlation on the surface of things, but that's only because the euro and the Swiss franc are positively correlated. The economies of obviously the rest of Europe and Switzerland are pretty closely tied together. So it's obviously one of those things that people are often asking me about is, how do we address the risk that comes with that? Because obviously if you are looking to minimize your risk per trade, or at least to manage the amount of risk that you have applied to any one particular trade, but then you end up trading correlated instruments, you might inadvertently be adding to your risk. So if you are trading, for instance, euro yen, euro US dollar, and US dollar Swiss franc, or maybe even Swiss franc yen as well, so you could end up with 4 highly correlated trades. That is absolutely true. And the question then is, how do you ensure that that doesn't happen on not only on an ongoing basis, but on a consistent basis? How can you, as always, be consistent in your approach to trading whilst looking to deal with that issue? And the answer to that, I generally find, is very much in line with the answers to how to prevent overtrading. So we will look at that in a second. The other way to look at correlation is in terms of time-based correlation. This is not the same as time frame correlation, which is a completely different topic. That is part of technical analysis and is actually a very useful subject, one that we obviously apply in our multi-time frame strategies. We take advantage of time frame correlation. But we're not talking about that today. Today we are looking at time-based correlation, and it might not be obvious on the surface, but it goes very much hand in hand with the instrument-based correlation that we were just talking about. Basically, what time-based correlation is saying is that, when something happens in the world economy, focusing obviously on our markets, does that affect different instruments at the same time? Or would it affect your different trades actually at the same time, be those trades across different instruments or not? So obviously you can see that there is a very clear connection between the two. So it comes back to the same question: how do we how do we alleviate the risk that we might be exposing our account to movements in the market that will affect different trades all at the same time? Just to give some illustration on this as well, for instance, the equity markets are a great example where people will often say, okay, well, if I'm trading S&P 500 and the FTSE and maybe the Hang Seng or the Nikkei, those are separate markets. They're different parts of the world, US, Asia, Europe. So my correlation risk there surely is going to be as low as it could possibly get. And for most of the time, that is true. But when we have cataclysmic market events, and last year was something of an example, obviously when COVID hit, but 2008 probably being an even better example. It's not that recent anymore, but in terms of my trading career, it still feels pretty recent. The fact of the matter is that all equity markets, their correlation tends to 1, which means that across the globe, equity markets all basically did the same thing at the same time, and they all crashed. So it is when the pawpaw really hits the fan that you need, as always, to be conscious of what kind of correlation will exist then. And this brings us back into one of my favorite topics that you guys who are part of the academy should all be very familiar with by now, is knowing that our biggest risks are hidden. The worst thing that could happen to your account hasn't yet happened. And if you are not taking that into account in your trading approach, then you are inherently fragile and your approach to the market overall is concave instead of convex. And that is at a meta level, I agree. But nevertheless, this is an important thing to take into consideration. And it brings us all back to the same question as to, what instruments should I trade? How many trades should I have on the table at the same time, etc., in order to alleviate this correlation risk that takes place, particularly when cataclysmic market events take place. It's also called a peso problem. Most of you guys weren't or have not been exposed to a cataclysmic market event. The reason why so little is understood by existing traders of these problems is because most traders who went through these cataclysmic market events are not trading anymore. We always talk about the graveyard, the trader's graveyard. It's very quiet. People don't tend to write books about how they lost all their money. So that is why very often some of the most important things you need to know about as a trader are not obvious. And people don't talk about them very much because most people who are talking today about trading are relatively new to trading and haven't experienced these types of market events. All right, so that's a general discussion about the problem. What then is the solution? So in order to be profitable as a trader, you will also understand that I keep talking about the fact that when conditions are not appropriate for your strategies, you need to stay out of the market, obviously. And when they are, even if it's across multiple markets, you need to make hay while the sun shines. When conditions are appropriate, you need to maximize your upside. You need to make as much as you can. And when they're not appropriate, you need to limit your downside. You need to pull back and you need to make sure that what money you have made, you get to keep. So in times where conditions are not great, and at the moment we are going through a period in the market where, generally speaking, across the board, conditions are not great, you need to be sitting on your hands and doing relatively little. And that will help you to avoid the cumulative risk that comes with trading in unfavorable market environments, certainly. But does that help you when markets across the board are favorable to you and you're making lots of money? What do you do if that all of a sudden comes to an end and the music stops? And even worse, where everything turns around and reverses. We had a bit of that last week, of course, where a lot of trades were stopped out with some aggressive reversals. Well, that's what our strategies are actually designed to help us with in terms of limiting downside and maximizing upside, particularly folks who have progressed to advanced targeting techniques. where you stand to gain with unlimited upside, but are continually looking to manage your downside. Uh, Obviously, those times where we get reversals and a lot of our paper profits go up in smoke might be uh, quite disappointing because you haven't made as much as you were looking to make in those market conditions. But that's exactly how it works. You need to make sure that you get out as soon as your strategy tells you that you need to be out of the market because conditions are potentially no longer favorable. They were, but when things change, you need to be out of the market. And this will also help with that. But it does still leave us with a situation where you can get into multiple trades and increase your exposure quite substantially to the market when conditions really are favorable across the board. That is true. So how do we deal with that? How do you prevent yourself from getting into, let's say, 4 trades across 4 highly correlated instruments, which is very likely to happen, of course, because they are correlated, when you don't actually want to have that much risk exposure to the market? Well, the first thing that we talk about is have a maximum overall risk level that you're prepared to take on the market in total. And depending on whether you're trading one of the funded accounts or your own personal account, where you're only trading your money or else potentially trading lots of other people's money, those are 2 extremes where you need to obviously be aware of the fact that your risk appetite is very different. So assuming you've got a relatively small account and it's yours and you're prepared to be prepared to take a lot of risk with that account, then certainly you can up these numbers. But generally speaking, when let's say you're trading your own money and it's reasonably significant amount of money, let's say it's you're trading a $20,000 or $50,000 account of your own money, and obviously this is relative from person to person. So some people might think that a $2,000 account is a lot of money, and that's fine, because if that is you, then you need to be aware of that, and your approach to your risk management needs to take that into account as well. But if you've just chucked in some risk capital, you're learning to trade, you feel like you're doing pretty well, and you want to grow a small account fast, and it's risk capital, and you're prepared to lose that money. And by the way, if you've got money in trading that you're not prepared to lose, you're actually in the wrong place. You should always be prepared to lose the money that you have in your trading account. Not that you will, not that you should, not that you're planning on doing that, but you need to understand that trading is quite a risky game, and you do not want to be betting the farm on your performance or the volatility of the markets. So assuming that you've got relatively significant amount of capital of yours that you are trading, and you really are intent on protecting that, you still want to get a decent return on it, but your focus is on making sure that you do not lose that money or any significant proportion of it, then I would recommend that you don't risk at any point in time more than 7% as an absolute ceiling of your account. If you're trading a smaller account and you're much more aggressive in terms of wanting to grow it, you can take that up to 20%. That would be extremely aggressive, but people do that, and that will allow you, if you know what you're doing, to grow that account quite fast, or obviously potentially lose it quite fast. But if you know what you're doing, then obviously the odds are in your favor that you will grow that quickly. But the volatility of your equity will be much, much higher. You need to understand that, and you need to be prepared to deal with that. If you are not comfortable with the volatility that comes along with that, and I'm talking about potentially like 50% drawdowns on your account, then you are risking too much. You need to be comfortable with the level of volatility that you're looking at. And I'd say a 7% maximum risk across the board will generally prevent you from having uh, more than a 20% drawdown. It's not all the time. You must understand that these are all probabilistic questions. There are tail events. There are unlikely scenarios that could certainly be much worse than that, but there's also that works on the upside as well. So 7% as a maximum risk exposure across all of your trades at any one time would be a decent ceiling for somebody who's reasonably conservative in their trading approach, but it is still quite aggressive, as you will see when we talk about funded accounts. Now, that's not the entire story, though. You need to also be aware that there is more specific correlation amongst certain currencies, if we're just focusing on currencies at the moment. That 7% assumes that there is correlation across all tradable instruments that you might be trading. Obviously, it helps to be in something like maybe a few commodities, gold, indices, and currencies across the board, because there is less correlation, let's say, between the S&P 500 and let's say the Aussie New Zealand dollar, then there would even be between the Euro US dollar and the Aussie New Zealand dollar. So, getting outside of currencies is also a good thing, but we also understand that most of the instruments that we trade are in fact currencies. So that's where our problem lies. Now, even if you're just trading currencies, 7% assumes that there is correlation across all of your tradable instruments. That's why we have that limit. But we also look to limit the exposure to any one currency as well, such as the US dollar or the yen. So what you won't do either is trade more or have more than 3% exposure to any one currency at a time. So you wouldn't want to have 3 brand new trades on, or more than 3 brand new trades with, let's say, the Japanese yen. And certainly in the last few weeks, the yen weakness has been probably the biggest theme we've had in the market in terms of tradable instruments. And certainly our profitable trades have largely come from yen-based pairs. So there has been the potential for having more than 3% exposure to the Japanese yen at any point in time. So what do you do then? Well, you need to then decide which ones to go for. And this is the question I know that all of you guys are waiting for me to answer, is how do we then choose out of all of those? Let's say you've got 5 yen pairs that are tradable. How do we pick 3? How do we go for that? Well, I'm going to come back to that in a minute and tie that into the problem of overtrading as well. So the other thing to bear in mind, folks, is that when I say a maximum of 7% or 3%, and these numbers are for you to determine as well. I'm giving you some guidelines here, okay? But they are for you to determine. When we talk about the funded accounts, I'm obviously much more specific with you folks, as those of you who are in the Funded Trader program know about your risk exposure. We have much more specific guidance there, as you know. But remember that using our strategies, one of the things that we're always doing is looking to minimize downside. And we do that in many ways, but obviously partly by using our manual trailing stops. Now, if you have reduced the open risk on a trade, let's say you're risking 1% per trade, and you reduce that with a trailing stop down to, let's say, 0.3%, that means you have opened up 0.7% of risk budget, if you like. Another just quick aside here as well is I'm just using 1% as an example because it helps with the maths and to keep things consistent. But remember, we talk about risk units. 1% might be the commonly used one, but if you are trading 0.2% initial risk on a trade, as you often do with an evaluation account and the funded account, that in itself is also a risk unit. So don't assume that I'm saying you should risk 1% per trade on your funded accounts, because obviously you know that that's something we don't do. All right, so I've got a quick question here from Surprise before I carry on into answering our final questions. If we're applying advanced targeting, we realize that the price has changed to phase 2. Will it be wise to just close that trade? Surprise, that's a completely not relevant question to this discussion today, but it's a very good question. So I appreciate that. I will answer that briefly by saying follow the rules of the strategy. Okay, advanced targeting, as you know, has ways of trailing the stop. That trailing stop will take you out if that pullback turns into anything that's, well, significant. All right. So good. So we basically at the point now where I've shown you that you can limit time-based correlation by keeping a maximum exposure of 7 risk units, be it 7% or whatever, across the board, or 3% per instrument. When I say it's not actually an instrument, per currency, if you're using currency such as be it the US dollar or the Japanese yen, any individual currency, make sure that you don't have more than 3% exposed at any point in time. Before I carry on, I just want to point out as well, this does not solve all of your problems, folks. Okay, so remember that gaps do happen. Okay, I think it was in Bug's Life where the princess was told gaps happen. So it happens in the markets. We know that gaps happen. And again, you need to be aware of that hidden risk where the pawpaw really hits the fan and you could have very, very significant gaps happening in the market. So certainly we've had that many times in my trading career. The best example in recent memory is already 6 years ago, amazingly. Doesn't feel like it, was in early 2015 with the Swiss franc debacle, where we had daily trades gapping, 3 or 4%. And really crazy stuff happening. And the question then is, how do we deal with that? Because that is also focused very much on correlation. Well, first of all, especially because we're trading higher time frames, that's when I say higher time frames, those were daily trades on a daily strategy. It meant that our losses were still contained. So the biggest loss we had, if you were risking 1% per trade, which we weren't, but had you been risking 1% per trade, then a 2% trade with a 2% locked in profit turned into a 3% loss. In other words, it was a 5% gap, which is huge. I mean, I don't think any of you guys, or maybe one or two, have ever seen anything like that, certainly on the daily time frame. But the point is, it has happened in the past. And not only can it happen again, it will happen again. We don't know when or how, but it will happen again. So how do we deal with that? Well, again, this is always about the question of correlation and managing correlation risk, is the number of open trades that we have on the table, but also the fact that we're trading across multiple instruments. So where we have markets where there is no correlation, then you will often have a situation where some of the trades lose and some win. And that's exactly what happened to us in January and February of 2015, where when the dust settled at the end of February, about 7 weeks after the governor of the Swiss National Bank changed his mind about a pretty key point, we ended up having the most profitable month that we've had in several years. So the couple of big losers that we had paled into insignificance in the end, because we were trading across multiple instruments that weren't correlated. And of course, you know that that's called diversification. So that's also very important, and it's a very important tool in our management of correlation risk, is this thing called diversification. And that's why as soon as you do graduate past the evaluation account on the Funded Trader program, you are also now able to trade the key indices and gold. And it's important that you do that for this very reason. All right, so those then are the most, the sort of the high level ways of managing your correlation risk, as well as your time-based correlation and the instrument-based correlation. So that's the starting point. Very important to apply that. But then what do we do, again, as I said earlier, when we still have too many instruments on the table, where conditions are favorable across the board? Well, first of all, there is obviously the need to make as much money as possible when conditions are favorable. You do need to make hay while the sun shines. It's part of maximizing upside. But whilst you're maximizing upside, you still need to be conscious of limiting downside. Now, the best way I find is not to now go and have a look at correlation tables. And by the way, you can, please do. Feel free to Google this, go and look at the correlation tables on myfxbook.com. I think they're very good ones. They actually show you on different time frames the correlation across different instruments. It's really worth having a look at, and it's a tool that you can use anytime. But it still doesn't help us because it's subjective in how we decide what to keep in and what to leave out. And this is where we start coming back to our filters that we have in our strategy rules, and why it's so important to have a robust technical analysis skill set in being able to evaluate whether conditions are more appropriate or less appropriate when comparing different instruments to each other. It's something that surprises me that after all the discussion that I dedicate to this, that people don't focus sufficiently on identifying which filters are looking better than others. And the best thing I can advise is that you go through the technical analysis training again, if you're not happy with this, in the academy, and make sure that you are really confident at a qualitative level what makes the difference between, for instance, a strong trend and a weak trend. Likewise, even with retracements, if you're looking at a pullback, would you trade a market where the pullback is weaker or stronger? Would you look to in terms of quality of trades as well, would you look to jump into a trade even though you've missed the initial setup? Or would you rather wait and only focus on those instruments where the setup is the first setup and that's the best one to get into? Would you jump in 1 or 2 or 3 candles late? These are very important, okay, for you to be able to judge in terms of what makes one trade better than another. Now, it doesn't guarantee that in that specific instance, the trade that you choose, even though it looked better on the surface, will be the best trade. That in that specific instance, it's irrelevant. It's very difficult not to see that when it doesn't work, okay? But it's very important that you understand that this is all about the law of large numbers. Our selection bias that we have as one of our very important biases will remember certain things much more strongly and be blind to other things, okay? And you need to understand that about yourself. So I would say make sure that you understand very clearly what the selection criteria are for each strategy. So for instance, if we're looking at an H4 impulse, we're here on the daily time frame, we're looking at the euro yen here, which is one of the better instruments that we've had over the last while. As you can see, we've at least had something of a trend. That trend did come to an end for a while. It gave us a resumption late last week, but since then it's basically been going sideways. So technically speaking, this is still being the phase one of a trend, but then we have to ask ourselves, well, would it be better to have an inside bar that's bearish or bullish? Would that make a difference to us? And of course, the answer should be, well, actually, yes. A bearish inside bar is less favorable than a bullish inside bar, yeah, as one example. But very often you don't even need to get there. What I've been seeing with a lot of you folks is that you will say, oh, okay, well, we're outside of the channel, so let's just go for the trade. Whereas, in fact, you need to be more than just outside the channel. You need to be outside the channel and have reason to believe that you are in a phase one or impulse wave of the trend. Also, if you're looking at one market where the trend is strong and the other is weak, which one would you rather go for? If you are not specifically trading outside C closes, but you now need to make a choice between what instrument to leave out and which to keep in, then why not use the outside C close as an additional filter, where one perhaps has been closing inside the channel, even though it's trending, it's a weak trend, whereas you can see that another instrument is clearly a stronger trend using the WM patterns, and not just WM patterns with reference to point X, but with reference to the 4-wave channel. I mean, here you can see our point X here is not the same as the channel. So looking at that as opposed to a highly correlated pair, which is the Swiss yen, the euro yen and the Swiss yen. They are very correlated because, first of all, the yen is 100% correlated to the yen. And as I mentioned earlier, the euro and the Swiss franc are also highly correlated because they basically belong to a common market. So which do you prefer? The picture that I've just shown you now on the euro yen or here on the Swiss yen? This is clearly a nicer picture, very clearly a nicer picture. Even the pullback that we've had is a prettier picture instead of basically going sideways. Hold on 1 sec, just want to grab a water. Now, I'm not saying that this one is going to win and the other one is going to lose. I'm just saying if you want to have additional filtering criteria that will help you to choose between two highly correlated instruments, this is definitely a better picture than what we were looking at on the euro yen. Similar kind of breakout. We had that initial breakout and single candle closing outside of the channel over here. That is pretty much the same picture. But over here, you can see we've had a much more obvious pullback where we've seen, in fact, the first trading opportunity that you have in this picture would have been the impulse candle over here. But let's have a look at that as well. And I actually know some of you have taken this as a trade. And in hindsight, it looks quite nice. But did you do the right thing? Well, no, because during the course of that day, the previous candle showed that we were in fact in a phase 2. So if you took a trade on this impulse candle, which, as I say, in this particular picture over here, looks quite pretty, it looks quite nice. In reality, if you do that, if you keep doing that, you are going to lose money on the strategy. Even if it worked partially, it hasn't worked completely yet, obviously, with the market coming back down now. But even if that were to work, then in this particular instance, would it work overall? And the answer is no. If you took that trade there, you were taking a trade whilst the market was still in a phase 2. Because yesterday we had no knowledge that that low was going to be ringed. We couldn't say that that low was going to be ringed yesterday. Even looking at this in terms on the 4-hour time frame, bearish cyclicity was still just about intact. Okay, we had a bit of a breakdown in cyclicity there. But if you were trading this in terms of the H4 impulse, then on the daily time frame, we were still in a phase 2. If you're trading this as a hybrid strategy, it's a different story altogether. But that is not what we're talking about here. If you're in a phase 2 on the higher time frame, those are not appropriate conditions for you to trade the H4 impulse on the H4 time frame. So that would be another thing that you just need to remember is just apply those existing filtering requirements that you have. If those aren't enough, then you can start looking to add more. What about the only taking the trade after the pullback? That's very, very important. Okay, so if you were going to take a trade here today, then in actual fact, this candle here was the first one with a stop below the low where you'd have been able to take a trade today. But you would have needed to have waited for an indication that we had a pullback. The pullback here is given by the fact that this low is lower than that low, and that is an inside bar. So yes, that's a valid pullback. But you couldn't take the trade here, not that it was a valid trade candle for today, because that impulse candle is preceded by 2 other impulse candles. So that's hardly after a pullback. So you wouldn't look to take it until you'd had the pullback. If that is still an issue for you, then I recommend that you start looking at other filtering criteria, such as the quality of the phase 1 that you are currently in, which would be again on the higher time frame. Are you in a quality phase 1 wave? The difference between quality and lack of quality is often seen when you compare phase 1 and phase 2 waves. So if you have reason to believe, technically speaking, that you're in a phase 1 wave because the phase 2 and the trend is over, but the price action of that is more typical of a phase 2 wave, then you can leave that alone as well. Rather go for an instrument that is showing that the phase one wave is of higher quality. What's the difference? Well, certainly higher closes if it's bullish and lower closes if it's bearish. Whereas if you have a mishmash and a mix of closes, some higher, some lower, even though you might have consistently higher highs to keep the wave going in a bullish wave, would indicate lower quality. And also that would indicate lower quality of cyclicity on the lower time frame as well. As I mentioned before, this outside C close is really a very good filtering requirement. So if we were looking at trading any instrument, if we were outside of the channel, but the previous phase two had encroached inside the channel, that would be lower quality because it would imply an inside C close. An outside C close is always an indication that the trend is stronger. So if you combine that with quality of the phase one, then certainly you're going to do a lot better. All right, so those are, I would say, in fact, the most important additional kinds of criteria that you could bring into your trading to help you to limit the number of trades that you take, particularly when market conditions are borderline or marginal. And there has been quite a lot of that recently. So will that work for you? Well, it depends on how determined you are to make it work, because you will then find yourself in situations where you're going to regret doing that. What do I mean? Well, there will be times where, based on these kind of criteria, you will stay out of some trades and you will have fewer trades on the table, and then things will turn really, really good, and you will regret not being in more trades. And again, your selection bias is going to ensure that you remember that experience very clearly. What it won't do is identify all the times that it actually helped you. So that overall, and again, coming back to our law of large numbers, overall, it is actually better for you to do that. We are so often, well, we are always driven by our emotions, and the emotions associated with missing the good times, be it an individual winner or generally having lots of winning trades on the table because you were too strict with your selection criteria, is a very strong emotion. The regret that comes with that is powerful. It's even more powerful, I believe, than the regret that comes with having losing trades. So you've got to watch out for that in yourself as well. This will, without a shadow of a doubt, prevent you from overtrading. If you've got, with one strategy, and the H4 impulse, it can easily happen. If you've got 7 or 8 or 9, 10 potential trading opportunities on the table, you're not being selective enough. Without a shadow of a doubt, you can be sure in your own mind that you are not being selective enough. When is asking, you mean to say a WM pattern within the channels is of less quality than one that's outside with an outside close? Of course, absolutely. So, you know, if you combine these techniques, and we've had training on this before, you know, if you're inside of a channel, but you've got a valid WM pattern, so C close is above or below X, above if it's bullish. So if we were to pretend that this channel over here was actually valid at the time, which of course it wasn't, you would notice that our C close in this pullback was above X. Absolutely. So in that, at that time, this was also the top of the channel. But it might not be, as we saw just now. So for instance, the top of our channel is also the top of our potential X over here. And in fact, we can actually move this along, this analysis, because we do have a ringed low here. So we can actually update that. It's not going to change the top of the channel, but you can certainly see, okay, I think that's still probably the same place. You can see that we've got an outside C close here, and it is also above X. Whereas when we look at Euro Yen, you will notice that that is not the case. Okay, here is our C close. Now, admittedly, it is also below X. It didn't need to be, though. If the C close was between X and the top of the channel, then it would be an outside C close in terms of the W pattern, but it would not be an outside C close in terms of the channel. So you tell me, which is stronger? Well, we're price action traders, folks. So we look at what the market is doing in terms of support and resistance. If it's a bullish trend, is it breaking resistance and respecting support? All of these techniques come back to that. So if this is something that you folks are maybe still not clear about, please go back and do the training on this in the academy, in the technical analysis training for advanced price action. This is all that advanced price action actually helps us to do, is identify this kind of stuff. So all of these techniques with WM patterns and 4-wave channels and 3-wave channels and HDCs and what have you are all there to help us identify how cyclicity is interacting with support and resistance. That's it. And therefore, is the market trending? Yes or no? Is it strong or weak? Yes or no? And what are the, is it phase one, phase two? Is it stronger? Is it weaker? You know, so yes, you can make these judgments doing exactly that. So the fact that this C close here was inside of our channel, and in fact inside of X to A, means that this is definitely weaker than Swiss yen, where clearly that is an outside C close, both in terms of X and in terms of our 4-wave channel. So absolutely right. Absolutely right. That answers that question. If you folks want me to do more training as well on things like quality of phase ones and so on, happy to do that. We've got training in the skill set or the technical analysis course in the academy on the anatomy of a pullback, I call it. You know, what makes one pullback better or worse than another? What is a pullback? You know, these are questions that people very often gloss over, just like people gloss over the difference between a range and a trend. They come up with simplistic answers to these questions. You need to make sure you have very clear, high quality, very high quality process for answering these questions. Generally speaking, I haven't bothered you folks too much about, you know, what makes a phase one better or worse, but it's all there in the training already, because a phase one wave is a trend on the lower time frame. And if you ask yourself, is it a strong or weak trend, we'll tell you if it's a higher or lower quality phase one on the higher time frame. You know, it's all the same stuff. There's nothing new. It's just applying the same stuff in different ways. And as far as I'm concerned, it's just basic common sense. As my old science teacher used to say, the problem with common sense is it's not very common. All right. Any other questions, folks? Because I hope you see that actually now answers this question as to how we can choose which trades to take and which ones not to take. It will also lead us to still make hay while the sun shines, because I mean, if you've got 5 markets where everything is strong, you know, and everything is 100% right, well, you will still go up to your maximum sort of risk exposure. Another point to make as well is that this kind of question is answered a bit differently if you're trading advanced targeting based on standard targeting, because obviously if you are in a trade with advanced targeting, then you know, you're going to have that trade on the table, but at least you would have reduced your risk down to 0. It's just that the structure of how trades present themselves is a little bit different. When you're using standard targeting, you tend to be getting in and out more quickly. But remember always that your risk budget does go up again when you've trailed your stop, especially to break even. Good. Not at all. I hope people take it on board. So obviously, if you don't know how to answer these questions around do we have a trend, yes or no? Is it strong? Is it weak? Are we in an impulse wave or a corrective wave? Is it a probabilistic one or a potential phase one wave, but not yet a confirmed phase one wave? is the phase one wave that we're in high quality or low quality, which actually brings us back to, is the trend on the lower time frame strong or weak again? So if you don't know how to answer those questions, obviously you're up a creek without a paddle. But that is obviously why we provide all of the training that we do to help you focus on learning a methodology that allows you to, not only know what the right questions are, which is pretty important, but then also have a methodical way of answering those questions in a process that brings you to a single point. And do I take the trade, yes or no? And unfortunately, most people don't even know what the right questions are. Generally, people will just ask me, oh, so where do I get in? Well, if you don't know the difference between a trend and a range, that's not the right question. If you don't know, the technical analysis is all about identifying whether conditions are appropriate for your strategies as opposed to trying to predict, which it's definitely not for, then you're asking the wrong questions. I can give you the right answer, but it's not going to help you if you're asking the wrong question. All right, folks, gone over time. I hope that that's been useful to you. I do hope that I've answered your questions on this. Please do pop any questions, further questions you might have into the comments below, particularly if you're watching this as a recording. Folks, have an awesome day further. For those of you in the academy, we will be looking to expand on this training tomorrow in the closed academy training. So please make sure that you attend. Awesome. Surprise. That's great. All right, folks, have a great day. Bye for now.